Thank you for organizing this very relevant and timely conference, and thanks for inviting me to discuss this paper. Johannes was saying that in this paper he takes some baby steps. This is a huge baby. I see it a little different. I think this is a tour de force on biodiversity risk. It's a very complete paper. It's a very ambitious paper. I'm sure it's going to be a reference in the future very quickly. At the core of the paper is measurement. To truly understand something, you have to measure it first. And this paper does a great job in measuring biodiversity risk. It measures it from different angles, from different levels of aggregation, at the aggregate level, using the news-based measures, at the firm and industry level, using different sources of information, 10K statements, also encuestas, surveys, and mutual fund holdings. So it's very complete. And he even does an analysis, which I think he didn't have time to present this, about whether it's how it's measured across counties. So there's a spatial and a geographical dimension to it. So measurement first. Once you have the measure, Johannes makes a connection between asset prices and biodiversity risk. And he finds that biodiversity risks are already priced into equity stock prices. And then throughout the paper, Johannes makes the very strong point that climate risks are different than biodiversity risk, and we have to think about them in a different way. I found this very interesting. In my personal experience, I have some limited knowledge on climate finance, very little on biodiversity finance, so I learned a lot from reading this paper. Moreover, the paper does a nice service to the profession. All the data is available online in the biodiversity risk website. That's a very generous act from Johannes and his co-authors. And I'm sure that many researchers, academics, and policymakers will use this readily available data to further conduct research on this topic. I would say that I think it's fair to say that Johannes is a leader in the new and dynamic topic of climate finance, and with this new paper on biodiversity risk, he's only strengthening his leadership. The topic of biodiversity is very relevant for Chile. I'm sorry, Johannes, that you're not here in Chile so you can see it with your own eyes, but we have a huge stock of natural capital. Our geography spans from one of the most arid deserts in the world, in the north of Chile, to the Antarctica in the south. We have the Andes Mountains with some peaks up to almost 7,000 meters, oceans, fjords, archipelagos, etc. And because of this variety of ecosystem and variety of climate, we have a huge variety of forms of life. More than 30,000 species, plants, animals, fungus, bacteria, etc. So biodiversity is very relevant for Chile. Yet, in Chile, at least at the finance and macroeconomics level, we have not studied this topic too much. We have done some work on climate finance. I was a board member of the Financial Market Commission for 6 years, and in the year 2020, we published the strategy on how to face climate change in the financial market with 3 main pillars. 1, disclosure. Firms and financial institutions have to disclose their exposure to climate risk. Second, risk management. Financial institutions have to introduce the management of climate risk into their overall risk management policies. And third, market development. Promote the development of a market that can finance sustainable activities. But this has nothing to do with biodiversity risk. It's all to do with climate change. That said, very recently, we have been moving towards understanding the effects of biodiversity risk, and here the Central Bank of Chile has played an important role. At the beginning of last year, the Central Bank of Chile published an important policy paper connecting biodiversity to macroeconomic growth. And more recently, just a couple of months ago, the Central Bank of Chile published a methodological paper to try to understand how to measure natural capital, different methodologies. And believe me, this is not an easy task. Moreover, at the beginning of this year, Chile became the first country in the region to create a committee on natural capital. What is the objective of this committee? To advise the government, to propose things related to the measurement, preservation, restoration, growth of natural capital. The idea is to introduce nature and biodiversity into the design, into the implementation of public policies related to sustainable activities. So as you can see, this is a very timely topic, a very relevant topic for a country like Chile. And Johannes does a great job. I have a couple of comments that I hope can make the paper even stronger. Number one, this is a question that I have for Johannes. Is biodiversity risk truly priced into equity prices? According to Johannes, the answer is yes, but I did my homework. And I read a couple of very recent papers, 2023 papers on the same topic. There's some European guys that actually find that biodiversity risk is not priced into equity markets. And then there's a newer paper by some French researchers that they identified this tension and tried to solve it, and again they find that biodiversity risks are not priced into equity prices. I am not an expert in asset pricing, but I would like to know what's happening here. Maybe this has to do with the difference in the biodiversity risk measures that are being used. If that's the case, it will be useful to understand what are the advantages and disadvantages of the different measures used by the different papers. Or maybe it has to do with different methodologies. If that's the case, again, it will be useful to understand what are the trade-offs between the different methodologies. So that's my first comment, to try to understand this tension in this very new literature about whether biodiversity risk is priced into equity markets or not. My second comment is a suggestion. So to analyze the connection between biodiversity risk and asset prices, this paper takes a cross-sectional approach. And my suggestion is to complement this cross-sectional approach with a time series approach. In particular, exploit the COP15 event. So as a reminder, the COP15 event was a conference exclusively on biodiversity. It took place in two different phases, first in China, then in Canada. And this conference raised awareness of biodiversity issues around the world. And in fact, if you look at the New York Times Biodiversity News Index that Johannes constructed, you can see a spike around this event. So there is some action going around this event. So then, Johannes, maybe what you can do is just look at what happens with stock prices before and after the COP15 event. That's the time series variation. And then for firms that have high versus low exposure to biodiversity risk, the cross-sectional approach. So I think it's fair to think that this is a plausible exogenous shock to investors' expectations regarding regulatory or transitory risks. And maybe this type of approach can complement nicely the cross-sectional approach that is already performed in the paper. My next comment is also a suggestion. So when looking at asset prices, this paper looks at equity prices. But then I ask, why not also look at bond prices? The biodiversity risk exposure could lead to higher default probability of a company and therefore higher financing cost. So here my suggestion would be to look at credit default swap spreads. Because the CDS spreads, they represent very directly and clearly a firm's credit risk. And the data on CDS is available from Thomson Reuters, so it shouldn't be hard to collect this type of data. The other nice thing about the CDS is that you can also look at the term structure of the CDS spreads in order to look at the effect of biodiversity risk on different horizons. As Johannes said in his presentation, the materialization of biodiversity risk depends on which horizon you're looking at. So looking at the term structure of CDS has that advantage. You can pin down in which exact horizon these risks are more relevant than others. So that's another suggestion, again, to further strengthen the analysis on equity prices. And to conclude, some thoughts about the policy implications of this paper. Johannes said that we really don't know if these type of risks affect the stability of a financial market or not. And we have the data. Johannes has provided the data to do this. So maybe the Central Bank of Chile, maybe the Financial Market Commission of Chile, or regulators elsewhere can try to answer this question. One possibility to answer this question is as follows. So look at banks. The regulators know exactly the exposure of the loan portfolio of banks to different sectors, retail, construction, energy, etc. And then Johannes provides a sector-level measure of biodiversity score. So in principle, what we can do is calculate a biodiversity measure of exposure at the bank level, which would be the weighted average of the biodiversity score of the industries in which the bank is lending to. And of course, the weights are just the relative size of the loans. So maybe you have a bank that has a high exposure in sectors such as real estate, utilities, or energy. Well, that would be a bank that would have a high exposure to biodiversity risk. And then, of course, the last step is to aggregate this bank-level exposure to biodiversity risk across banks in order to get an aggregate measure of exposure at the banking level. So you have the aggregate exposure measure, which is relevant from a macro-prudential point of view. And you also have the the individual bank exposures, which is relevant for a micro-prudential point of view. Maybe the aggregate exposure is not too high, but there could be a particular bank in the system that has a very high exposure to this type of risk. So identifying that financial institution, it could be very useful from a policy point of view. And of course, it's very easy to add a time series dimension to this. You can calculate this type of measure at the monthly level where you have the data, and you can see whether the exposure is increasing in time, whether it's flat, or whether it's decreasing. And then it's also very natural to extend it to other financial institutions. In the case of Chile, there's two other main financial institutions besides banks that are very relevant: life insurance companies, and then also pension fund managers. And then you can do the exact same formula than before, but instead of thinking about loan exposure, you think about securities exposure. So what you want to know is whether the portfolio of securities of these two institutional investors, to what degree are they exposed to biodiversity risk, and how does that exposure vary in the cross-section of institutions. So again, Johannes, thank you very much for writing this paper. I hope you will publish it in a top journal very soon, and you will get many citations. Thank you very much.
Thank you, Mauricio. I don't know, Johannes, if you want to answer or comment about Mauricio's suggestion, proposal, and question.
Great, and I'm sorry I'm not there with you to hang out and catch up in person. Your suggestions are all great, and again, I still view this as largely dipping our toes in terms of the scope of the analysis, and all of the things you suggested are things that we or maybe someone else should undertake to kind of build this field further. I think the one thing I do want to comment on briefly is sort of the apparent tension you highlighted with the two other studies that have undertaken this paper. The studies differ on both of the approaches you mentioned. I think one of them is data, and we construct our own exposure measures that are public. They use data from a private vendor called Iceberg Labs that I do not have access to. So I don't know the extent to which the exposure measure contributes to it. My sense is it's not the main reason. I think the main reason is methodological. So the other two papers take the standard asset pricing approach, where they sort portfolios similar to us, again, a different exposure measure, but let's assume they're the same. And they go long the high exposed firms and short the low exposed firms. And what we should observe in principle is if the risks are priced, you should expect the more exposed firms to outperform, right? You require a risk premium to hold the more exposed firms. They should do better. They don't find that in the data. And I think the reason they don't find that is because we have a structural break in the middle for exactly the reasons you pointed out. And in fact, reasons they find in their own work, things like the Montreal Agreement, etc., have changed people's attention to this type of risk. And so what has happened is during the sample period, imagine in the beginning, no one was worried about biodiversity risk. And by the end, at least some people are worried about this. What would happen over the period from no one being worried to some people being worried? It would actually lead to an underperformance of the more exposed firms, because suddenly this risk that you previously didn't care about, you now worry about. So they would underperform in sample in order to give you a higher expected return out of sample, right? But when you have structural breaks like that, the approach of saying, well, in sample they underperform, so I can't find evidence that they have a higher expected return. No, we can never measure expected return. We can only ever measure realized return. And in some sense, the reason they outperform now is so that they have a lower price and a higher expected return going forward, right? So whenever you have structural breaks within a sample about attention, to a risk. By the way, we have the same with climate risk, right? We have ESG should underperform because it hedges climate risk, yet in sample for many years it outperformed when we transitioned from a world where nobody cared about climate risk to a world where we cared a lot about climate risk, which led to great performance of solar stocks for many years. That doesn't mean solar stocks, are risky in terms of climate risk exposure, right? In fact, I think they're going to underperform going forward. They're going to have a lower expected return. But during the period when we started learning about the risk, they had a high in-sample return. And I just think the approach that these papers take in terms of equating expected returns with in-sample realized returns during a period when attention to a risk changes so much, I think doesn't work. And in fact, when you look at the papers, in terms of covariances, which is, I think, what still works, they find exactly the same thing. So the beauty of sitting in front of my computer rather than with you in Chile, I can actually pull up the paper again. And in the last sentence, what they say is, they say that consistent with this finding, stocks with a large footprint lost in value the days after the Kunming Declaration. It's exactly the analysis you were suggesting, right? So in terms of covariance, they find exactly the same thing. And in fact, they even argue that investors have started to require a risk premium going forward after Kunming. So that the outperformance might have ended, the underperformance might have ended between now and then. So I think just any paper that just looks at relative returns of more and less exposed firms, equating an in-sample return with an out-of-sample expected return during a period when there's structural changes, I just don't think it's the right approach, which is why we picked the covariance approach. And in fact, to the extent that the other papers also look at the covariance, what happens to prices around big announcements, around big news events, the results line up quite nicely, which makes me think that it's not the fact that the iceberg lab measure is so different to our measure, but that it's really the methodological approach where, for the reasons I described, I prefer the one we took.
Okay.
But thank you very much for the discussion. It was super helpful.
We have some time for another question. Please, go ahead.
First of all, thanks. This is really interesting paper. It's really interesting work, and I'm so glad you're making this all public. That's a wonderful service. I had a question for you. So I was puzzled. You were saying that that you really don't want to take a longer term view of this, or that you're going to only look recently. But the Endangered Species Act was passed in 1973. So if you looked at parts of this, like particularly thinking about things that could cause problems for endangered species, it would seem like you actually have a long history in the U.S. So I was kind of interested or thinking about particular parts of biodiversity. As you said, it's everything. But could you be looking at things which affected species, and then measures which would be for particularly like land-based? So anyway, that was the basis of my question. But anyway, thanks for a really interesting paper.
No, it's a great question, and in some sense, it's impossible to know when to start. Because you want to start measuring, like you don't want to include periods where you could be pretty confident that it wasn't priced, because it's not going to teach you anything. And it's going to confound what you observe today, but we don't really know when it started being priced. And so I do think, your idea that maybe some of the regulatory risks, at least around Endangered Species Act, have been around for a long time. I agree with you. For those subsets of the risks, it might be possible to find pricing even earlier. Part of the reason why I'm not 100% sure if it's going to work, but again, it's an open question, is when you think about the time series of the risk disclosures, right? They've gone up by a factor of 4. So between 2000 and today, about firms that talk about any types of risk, including the transition risk related to regulation, such as the Endangered Species Act. So there's a question about, did they not disclose it because just no one in finance was paying attention? Is it because it wasn't enforced then and it is now? But that's something that one would have to think about if we're going to take that longer term approach.